Well, hi everyone. I'd like to welcome you to today's webcast, and I'm really glad you're here. I'm Leslie Jouflas. Trading Live Online is my website, and you'll see my email address on here. It's right here. If you want to send me an email, if you have any questions after this presentation, which I am really excited to be doing. I really like this topic. And I feel that this is one of the more important aspects of technical analysis that traders can focus on to learn how to be more consistent in their trading. But just a little bit about me, and then let's get going because I've got a lot of information for you today and not a lot of time to do it. So we'll see what we can get through. I've been in the markets teaching and trading for over 25 years. I've written many articles that are published, and I've got two books that are published, one with Wiley and Sons. Trade What You See, How to Profit from Pattern Recognition that I wrote with Larry Pesavento. And this book is now available in 6 languages. It just came out in Spanish thanks to the hard work of some people. So we're really appreciative of that to bring it to more traders around the world. Now, the other book is Essentials of Trading. It's not what you think, it's how you think. Notice up here, master yourself, master your trades. Well, the mindset is so important. One of the most important tools, the most important tool once you learn how to approach the markets that you have. And so, Larry and I, once again, we did a compilation of different articles. Uh, Most of them on trading, but they're a lot of just our experience. And we just sort of wrote them out and put it together. So it's no longer available in print, but I do have it as PDF. Okay, so today um, we are going to talk about um, the range trading, identifying range trading versus trend trading and power patterns that go along with this. Now, there's only a couple of things that the markets do. And to illustrate this point today, I've put together charts from present and going back 100 years. And I really want to show you and really drive home to you that there isn't anything different in price behavior. It's really interesting because traders new to the markets, they have so much energy and enthusiasm, which is great, but they lack focus. Not good. And today there's so much out there. There's a million videos on YouTube. It just everything all over the place. So it's harder, I think, to focus now on learning how to trade. And traders new to the markets can usually easily spend when they come into the markets 3 years, 4 years, 5 years in a circle, and they're kind of always trying to find something easy money. And then after a period of time, they usually either give up or they start to take some courses that are really going to help them, and they have to have that focus in order to learn what they need to learn. So I'm here to show you really in technical analysis some principles that you must learn and focus on in order to put together a trading method for yourself. And that should always be combined with your own personal mindset. And you don't need to reinvent the wheel with trading. And I hope that this illustrates that today as well. So let me show you one of my favorite quotes up here. Avoiding stupidity is easier than seeking brilliance. So we don't need to go out and find, some new way to reinvent the wheel here. But here's a lot of things that new traders tend to gravitate towards. Just trade 20 minutes a day, make 2,000% a year, or whatever they say it is, or follow the gurus. Gurus. Boy, that's just, we should just take off one, take the S off and leave it as a four-letter word. There are no gurus. There are people who have worked hard and studied many aspects of technical analysis in trading. They're mentors and they're good people and they're usually pretty low key. And you're probably not going to see them popping up on YouTube ads that much. Anyway, and then there's the follow my brother-in-law's trades and make 500% a year. Well, it's a drop from 5,000, but not bad. And then there's also this one. Here's our monthly results. We have an 80% win-loss ratio this month. Well, okay, let's talk about that quickly. That means nothing. This means absolutely nothing because maybe there was one or two losses big enough to wipe out the wins, and maybe they broke even or took a loss. So the metrics that you are being shown can be cherry picked. And so another way people are, as I mentioned, trying to learn is YouTube videos, and probably not. So what you've got to do again is you've got to focus. You have to learn from classical technical analysis. If you're using charts, you must learn classical technical analysis. And you've got to find patterns that you can understand and that repeat enough that you can create a trading plan that goes with your mindset, not mine, not anybody else's, with yours. And then understand how to apply some simple metrics to the outcome of trades. And please remember this, that it is never ever about one trade. One trade should never make a difference. So you've got to create your own track record and prove to yourself that the method X, whatever it is, works or it does not. Okay, so now stepping down from my soapbox, here we go. So let's go back 100 years or so. W.P. Hamilton, he took over for Charles Dow as editor of the Wall Street Journal. And so this chart is from a book that I have from W.P. Hamilton back there. I've got a whole bunch of old, really cool books. And I want to trade setups that I know are repetitive and that I can create a profitable trading plan with, which doesn't mean that every trade or even every month is going to be profitable, but I know that over time I'll be profitable. And I want to be able to evaluate that process. And here's something important. I want to know exactly how I made or lost money. That sounds simple on the surface, but believe me, when you start really hunkering down and focusing, you'll find that there are particular steps that you can take to achieve this. And that's always going to help you turn a corner to a better path. Okay, so we want to, keeping in mind that we want things that are repetitive. So we're looking back 100 years here. So we can see that the market, which only does three things, it goes up, it goes down, it goes sideways, it goes up, it goes down, it goes sideways. So nothing has changed. So this is a chart of US Steel from my book. That's from 1922. So let's look at the next slide of US Steel. So I was really curious, and so I looked up this chart when I was going through Hamilton's book, and I thought, I wonder what US Steel is doing today. And so I literally pulled it up, and here we have it. It goes up, it goes down, it goes back up, it goes sideways, and it's remarkably similar to what I just showed you. And I just pulled up the chart at random, and there it is. So why is it important to understand that you can build your approach and your trading plan based on this type of simplicity? It tells us that excuse me, I need to click a button here. Sorry about that. That was my phone ringing. I had to change it to that tone because I have Roma, my German Shepherd. If she hears a phone ring, she is all over it. It's the type of market environment determines our trading tactics. So if a range trading environment, then or trend trading, then you're going to switch the tactics with that. So, with some practice and study, you can learn to spot early signs of the environment and shifting from one environment to another. And this is what I work with traders on. We work in detail on this type of work. And one really great part, the patterns I'm going to show you today, they can be traded in either market environment. So I'm going to show you ABCD patterns, the Gartley pattern, butterfly pattern, triangles, rectangles, head and shoulders. Bull flags and bear flags are the exception. They really should only be identified and traded in trends. And we're going to look at a chart in just a minute of these things. But now we're going to look at, this is a chart by H.M. Gartley, 1935 Profits in the Stock Market book. These are hand-drawn charts, and there's no difference in the price behavior. We have up, down, sideways, contract, and expand. And so he's illustrating here price levels and action that dictate the trading action taken. So as an example, here with this red arrow is, he says that this is a danger zone for shorts and shorts to be covered on the reaction. And that's because this downtrend here is shifting, and it's shifting now. You can see on this chart, it's shifted to an uptrend. Sometimes they'll shift to a sideways trend, but he is correct in saying, that this is an area that has to be monitored if traders are short. So that is a very simple illustration here using just price and a trend line of identifying something that's very, very important. Okay, so contracting phases are followed by expansion phases. Expanding phases, expansion phases are followed by contracting phases. So generally what you're going to see is on the left, the prices are testing upper and lower ends of the range. That's a contraction. That's a coiling process. The market eventually is going to wind down and probably might get a little bit quiet. There might be a particular price level within that range that it starts to really trade around. And then a breakout will follow. And we're going to look at some examples of this and some specific patterns associated with this type of a process. This is a rectangle pattern that I'm showing you here. And there's tradable patterns within these types of formations. However, they're traded differently than what you would find in an expanding type of a market. So the chart on the right is an expansion phase, and there can be catalysts like such as this long bar. That was, I think, a FOMC announcement or economic announcement. Those can put sudden moves, gyrations into the market. So let's take a look at kind of what happens in these phases. So the uh, contracting phases, again, they can be range trading like the sideways. They can be within a trend. They can be like a bull flag or a bear flag, a triangle, even a rectangle within a trend is a contracting. But if you know that you're in a trend, then there's a particular expectation of that type of a pattern. So again, think of the contracting phases as stored energy, and it's going to explode from some of these patterns. So in the contracting phase and seeing that testing process up and down, then we can see that there's different patterns in there, ABCDs, Gartley patterns. I'm going to show you real quickly what these are. Butterfly pattern, I'll show that to you too. Triangles, probably a lot of you are familiar with those. And then the contracting phase is eventually going to be followed by the expansion phase, and this can be the start of a new trend. And They can also be the continuation of an existing trend. But when they are in, and I'll show you chart examples, when they are in particular phases of accumulation or distribution, then this is where some of the big trends are born. That's what I like to say about them. Okay, so expansion phases, which are trends and follow the contraction, they can be short-lived or they can be long-term trends. There can be different trends on separate time frames. You might have, we've been in a downtrend since late last year, early this year, but within our downtrend, we've had series of uptrends. The uptrends generally are going to make higher highs, higher lows. We'll look at charts of that. So I'm just going to run through this. The daily ranges you may see expand, downtrends in particular. On the downtrends, you're going to see more volatility and probably larger range. And we were seeing over 100 points ranges on the S&P 500 during a lot of this downtrend, and the ranges are not quite as big on the uptrends, although they can hit 100, but not as often as on the downtrends. So again, the expansion phase is going to be followed by a contraction phase. Now, both of these phases and all of these patterns I'm going to show you are fractal. And that means that they all are going to appear on all different time frames across the board. Okay, so here we go. This is how we can define an uptrend. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Okay, pretty simple. That's one of the three things we see. And here's a downtrend. We already looked at the range, a sideways range. So here's a downtrend, and it's just opposite. You have lower high, lower lows, lower high, and lower lows. And we can use trend lines, different things, different technical tools, but you can do so much with just price without ever putting an indicator on your chart. When I work with students, we work with price for quite some time before we ever put an indicator on the chart. And so I have I have kind of a saying about that. It's like, unless you know how that indicator is helping you make money or lose money, you take it off the chart because it's really just a distraction. Okay, so now this chart is showing us a principle that momentum, which is how fast price travels, and we can measure that in different ways. But it will start on the smallest time frames first, and if there's a big enough ripple effect, then it will work its way out to the longer time frames. So sometimes you'll only get an intraday time frame, a trend. It's not strong enough to move the longer term trend, or it's not moving strong enough to move price out of a range on a longer term time frame. It could be an uptrend within a larger downtrend, and vice versa. So maybe the market is getting ready to change trend. The longer term time frames may show a larger ripple, like the chart we looked at, by news or economic conditions, and it really depends on how large of a rock is dropped in the pool. So let's keep that in mind as we move through our charts. So our types of patterns and trends. So triangles and other coiling types of formations. I want you to kind of remember this term. We're going to look at an example of this. This is a power pattern. Rectangles, which I call money boxes, bull flags, bear flags, trends only for those. All of these except for bull and bear flags can be traded in either environment, the trending or the ranging. And then you have head and shoulder, inverse head and shoulder. Now these are reversal patterns, but they are sometimes found as continuation patterns. Butterfly patterns, these are known as reversal patterns, but they can show up also within swings. So these, they can have sort of dual purposes. And then we have retracement patterns. So the Gartley, ABCD can be retracement patterns, and the butterfly also. Then there's these patterns, 3-drive patterns. Some of you may know this pattern or may not know it, but I'll show you some examples. And we can also use Fibonacci retracements and extensions. So let's quickly go through this ABCD pattern. Now you've got it on your screen so you guys can study this, but I'm just going to quickly show you the outline. So it's like a lightning bolt. So you see A to B, your retracement leg, and then your C to D leg is going to be equal to, or it might be a bit of an extension um, of the AB leg, meaning that CD might extend a bit longer, and we can use Fibonacci ratios to help us determine where those are. So here's a few, let me go back too soon. So here's a couple of things. The C leg must be below A for a buy pattern. So if your retracement comes up above A, it's not going to be the ABCD pattern. And same thing if it's a sell pattern. So the buy patterns, the lightning bolt is coming down. Sell patterns, lightning bolt is moving up. So you can, again, you can study that later. I put these slides in here so that you can use them. So notice how our lightning bolt, this is a sell pattern here. Got some Fibonacci ratios in here. 618 is retracement. There's a number of Fibonacci ratios we can use to identify retracement leg. The 127 is taking the length of that BC leg. So that's your retracement leg, taking the length of it, multiplying it by 1.27. You add it to C, and that will give you projection. And we can also use a 1618, but just get the idea that this swing here is going to be an extension. Okay, so I'm going to leave that there and let you guys study this. If you have a question, please email. So let's get into a range. So what does a range look like with these patterns? So here we have the contraction, and there's many patterns in this range. There's a AB equals CD, there's a buy and sell pattern, there's a Gartley pattern, I'll explain that, and a butterfly cell, I'll explain that. Both of those contain AB equals CDs. There's head and shoulder pattern, inverse head and shoulder. There's triangles also within here. So let's sort of walk through it. I don't have them all labeled in, just a few of them so that you can see. So if we start down where this blue line is, we go A to B, B to C. There's the retracement. Within that retracement leg, another A, B, C, D. And this can help us identify where that swing might end. And then this turns to a larger swing, A, B, C, D for a sell. And that gets some retracement. Now here's where a butterfly cell is. You see where this A, B, C, D is? Well, this makes it a butterfly because the AB, the CD leg extends beyond that previous swing point. Now these are reversal patterns, and this is known as a powerful reversal. In this instance, it got a big move down to the bottom of the range. Sometimes it doesn't always get that big of a move. Sometimes this can form and it doesn't get anything and it keeps going. That's why we use stop losses. Maybe it'll get a retracement, maybe it'll get an extension, but I think you get the idea there. Now down here, we have an inverse head and shoulder pattern. Left shoulder, head, right shoulder, and that forms A, B, C, D cell pattern there. Here we have a head and shoulder pattern right in the middle of the range. It's testing that center price level, and it breaks and tests down towards the bottom. Triangle. So you can see how many different patterns within this range that we can identify, but you have to know that you're in a range. Now here's a tip for identifying if you're in a range. When the market has gone through an expansion phase and then all of a sudden it starts getting these wide swings down, up, down, up, down, up, and now you can't make sense of it anymore, you're likely in a range. And so when you suspect you're in a range, just try and find the trend lines and see if you can map it in. They might change a little bit as the range forms, but you just adjust the trend lines with it. Okay, so back here, back to H.M. Gartley in his 1935 book. Now, uh, chart. Now, again, all hand drawn. So he's showing us here an expansion phase. This is a downtrend, and he's uh, showing the patterns. Here's the preliminary liquidation phase. This is a downward sloping parallel trend line channel, and the price drops. Notice the price comes up. Here's an A, B, C, D sell. Here's an A, B, C, D buy. Remember how I just showed that to you? It forms that retracement leg, and then you get your final leg here, drops out of there, and it forms another tight symmetrical triangle, and so on and so forth. Now, right here, this is called a dynamite triangle, and I'm going to show you a little bit better example of that. But that's a very powerful type of a triangle. They're a little bit hard to find on the charts, but if you can find one, it's well worth it. Now, this chart is from 1911 to 1938. And again, remember, these are all hand drawn, which I find just they're like works of art. And so we're looking at a period where we had a large consolidation period. The lows in 1921 started this tremendous uptrend to the 1929 high. Now, here's an excellent book for you. Ralph Acampora, he started the Market Technicians Association in the 1970s. He's amazing. He wrote a book called The Fourth Mega Market, now through 2011. How 3 earlier bull markets explain the present and predict the future. If you want to understand something about these types of large cycles and these big mega markets, definitely pick up his book. You can Google it on Amazon. Ralph Acampora, Acampora. So this had a huge run here, and of course we all know about the 1929 crash. But you can study this and see the trend lines that Gartley put in. Here's the head and shoulder pattern, left shoulder, the head, the right shoulder, and how he drew in the major trend lines for this. He's got the volume patterns on this, but we can see over this long period of time, we can see the contraction, the expansion, the up, the down, the sideways patterns. And so again, here's, sharp move up, sharp move down, sharp moves up, sharp move down. You're in a range. That's a huge range, and it's a very long, very, very long term range. But look how powerful when it came out of it. Notice here also when it comes out of the range, this pullback here, little pullback here, comes back and kind of retests everything. So really beautiful charts to study. So now here, let's take a look now at a little bit closer to home of patterns in an uptrend. This is from an intraday chart of the S&P 500. And so remember I told you that bull flags and bear flags, those really should only be traded when you've identified there is a trend. And bull flags and bear flags need to have a pole in order for the flag to be formed. So when you're in a range, and let's say you have a high of a range right here, and you get a bull flag, well, that's not a great signal. However, if you learn the different phases, trend versus range, contraction, expansion phases, and you know that you are just in the first early phases of expansion, then these are going to be very high probability trade setup. And so that's something that is worth knowing. The longer the trend goes on, then the less, the less reliable these are going to be. So I marked in here even an ABCD cell here, ABCD, but you wouldn't want to take that because you're in a new uptrend. So the odds are just not going to be with you. Again, knowing the market environment that you are trading. So we can follow the price along, but here's an ABCD buy pattern, ABCD here, and that continues the trend to the upside. It goes into a consolidation phase. Remember, we can have the consolidation within the trend, and then the expectation is going to be for trend continuation. Now here's a little dynamite triangle that we just looked at. And the next slide, we're going to see a little bit more detail about this. But this being a short-term intraday chart also illustrates that fractal nature. So, I mean, this could be a 60-minute chart or a daily chart or a weekly chart or a monthly chart. It's going to form the same types of patterns. Of course, on the intraday charts, they're going to form them faster. And you don't know if that ripple that we talked about, if this 5-minute trend had enough power to the underlying forces, from the underlying forces to spread out to those larger time frames. So that's always something to keep in mind of, are you trading an uptrend within a bigger downtrend, or are you trading this uptrend with a larger uptrend? That's important information to know. Okay, so let's go on to the next slide and let's take a little, here's our dynamite triangle. So let's take a look at this from Gartley's book also. So figure 18, so it says, let's see, although most frequently will be followed by a continuation of the previous trend. He's talking about the dynamite triangle here. An actual case may be seen on chart 18. This is figure 18. The next chart is chart 18. So here in the figure, he's showing us what that little dynamite triangle looks like. He's got it outlined, but I stare at a lot of charts and these form very, very quickly. But they are like little dynamite powder cakes because they can be very, very explosive. And he says here, in many instances, the dynamite triangle is followed by a sharp movement of from 2 to 8 days, which is from 3 to 4 times the amplitude of the pattern itself. Now, if you're on an intraday chart, then the followed by a sharp movement from 2 to 8 days is probably not going to apply, but you could apply the amplitude of the 3 to 4 times the size of the pattern. So remember that the water, the pool image again. So think of this phrase, the maximum extent of a vibration or oscillation measured from the position of equilibrium. And that's really what this is. That's telling you that there's a resting point in here and that you're going to get a maximum extent of the vibration or oscillation of price with that. So here is chart 18, and this is really interesting. Again, get Ralph Akampora's book. He's going to actually talk about some of these companies. People's Gaslight and Coke company. So Coke, we're not talking about Coca-Cola. We are talking about the Coke, the porous carbon-rich material that was used to make steel at the time. So a lot of these companies here are no longer no longer around because new technologies, new materials came along, and that was that. But there are still some. GE, Chrysler, Buick are still around, and a few others. So here again, this is just illustrating. Um, our downtrend patterns associated with it. Here's a dynamite triangle right here. If we were to take off the outline that he has drawn in, this would be difficult to see. But just know that it's only going to be a couple of bars. This one is 1, 2, 3, I think, maybe 4 in there. And that's it. So that is a big power pattern. Kind of a neat old chart, isn't it? Okay, so now let's look. So parallel channels, this is an upward trending parallel channel, and it's also a type of coil. We can draw trend lines around it. I like to use the center line, the internal trend line with this. Because I find that the market will hover, come back and keep testing around that center line, and eventually it's going to move out of the entire pattern one direction or another from that center line. Notice I don't have a ticker on this either. This could be from 100 years ago. It could be from yesterday. It could be a 5 minute. It could be a daily, a weekly, monthly, or longer chart. But we can see the patterns in here, A, B, C, D buy pattern down to the lower end. Notice how the market, it had actually been trending up, and then it had a large swing down, back up. Remember that large swing down, large swing up, swing down, swing up, swing down, and you're not going anywhere. So see if you can find the trend lines and start drawing those in. So we also have in here, over here, there is a head and shoulders pattern right up at the top of the trend line. That brings the price down to that center internal trend line. Lots of different tradable patterns, but you have to recognize the market environment that you are in. So now let's take a look on the next chart at, again, we're going back almost 100 years now, Schabacker, from the book Stock Market Theory and Practice. And this is out of one of my books that I have as well, that I very carefully opened and took the photocopy of it, hoping not to hear the binding crack. Some of these are just very, very old now. But here's GM. So here's GM from 1928. So this is just a year before the crash. And we can see the sideways coiling type of a pattern. Here's a B, C, D cell type of pattern within the range. Price comes back down to the lower part of the range. But look at how that price comes out of this basing pattern. So this was an accumulation pattern happening in GM. It was towards, this was an incredibly speculative time in the market. And so you can see this huge move to the upside from this. Again, trends are born from these types of coils. So Schabacker says chart formation indicating preparation for a major movement is the ascending bottom. And so here is what it looks like. These formations are quite suggestive of the triangle or coil movement. So let's take a look now. Let's come back up close to 100 years. And here we have NBR. This is an ascending bottom, very similar to what we just looked at. Market had a huge run up, kind of a blow off, deep retracement, big swing up, finally settles down over, this is a 3-month period, and then here's a gap up out of that, and starts to trend to the upside. So these ones, generally, I think this one was in my weekly market setups, and we cover these patterns every week. These patterns, A, B, C, D, all of them I'm showing you. It's what we cover. And I do a lot of training with the technical analysis. I walk through these charts to not only they can be used as trade setups, but you'll learn a lot about this technical, the classical technical analysis and the patterns and the market environments. Here's one of my favorites, Microsoft. This is on a monthly chart. So each bar is a monthly bar, and you can see after the 2000, 1999, 2000, 2001 crash, Microsoft was in this extended coiling, ascending bottom that we just talked about. And here's the, you know, a line where the market was coiling around this price level. So I'd actually drawn this line on it, you know, way back. I tend to, when I can recognize it here, I will draw it on and then extend it out into forever in time, or until it does its thing. And so here back in 2013, 2014, notice how there's just a small consolidation. It's not getting the resistance any longer. It's just hovering around that, and it breaks out, it retests, and then it starts the huge trend to the upside, Dynamite triangle in here, and that's on a monthly chart. Okay, so I think you get the idea on that. So sometimes they can be on a 5-minute chart. It could be on a monthly chart. If they're on a monthly chart, then that's going to be a longer term hold, so to speak. You just hold it until it's done going up. So another example of a long period of 30-year period of the up, the down, the sideways. Again, this is from my William Peter Hamilton book. This had 12 industrials at the time, 29 railroads. So the railroads, you know, that was the one of the new technology. It was part of one of the mega markets, because as the railroads expanded, goods and materials were able to be transported all across the country, which couldn't have been done efficiently before the railroads. So that was quite a big boom for a while. So here we can see again, here's the 1921 bottom, and we can see the industrials start to take off from that up to, you know, we don't quite have the this ends at 1925. So we don't have the 1929 top end yet. This was drawn before that period. Okay, let's see. Now, I thought for fun, I'd put a blank chart up. So here's the concepts and the patterns that we have been talking about. So we can see there's a downtrend with corrective pauses. So on the next chart, let's add a little bit of structure, and let's see what happens with that. Let's see how you can add structure to a chart. Okay, so here are all the concepts that we've talked about today. And we've got up, we have sideways contraction, more contraction up here. So sideways range. Here we have, you know, sell pattern in here. We have a break to the downside with with big long bars to the downside. We have this triangle. I think there's a few more bars than should be for a dynamite triangle, but nonetheless, it's still got a big move. It's the first consolidation actually after the break of this, and generally that first pattern is one that you want to be looking for. This one, sometimes it'll come as a test back up towards the breakout area. This one just fell. It didn't have any breath to it to be able to get back up that high. So then another consolidation here, another break. So here, if you know you're in the trend, then the expectation from these patterns are going to be trend continuation unless the market tells you otherwise. So these are once you understand and you can spot these on a chart, these important concepts, contraction, expansion, range, or trend, then you can learn where the opportunities are with that. So here, again, we have more patterns in here. A, B, C, D sell in here. A, B, C, D buy pattern down at that trend line. Another rally up. We have a head and shoulder pattern. And notice how it breaks and the retest of the broken neckline there. Then a gap to the downside breaks this trend line. We have the expansion coming from that back into a big range. This range, sometimes ranges are not, sometimes I will draw several lines where I think the price is clustering, such as this pink line here, and then below it I have where the lows are here, and so I consider them both, support until they're not, and then I'll do the same thing at the top. This one was a little more clear cut, and then the dash lines are just sort of showing the same thing. This is consolidation here. So this broke, so I drew a little dash line across, and same with this pink one. It just helps me to identify these areas. So expansion, here's a dynamite triangle. Remember range, sharp moves up, sharp moves down. Okay, so let's now look at one more chart. This is a 240-minute chart of the S&P 500, and the market had been stair-stepping up this last, this is 2021, 2020, from the lows all the way up to the highs, late 2021, early 2022. And so this was sort of typical. It would go into these ranges and then break out, range, breakout, range, breakout, like that. And you can see here that not all breakouts are just clean, where they just, like this one. Here's a nice clean breakout. Breaks out and it keeps going. This one has to drive everyone crazy by testing up, down, and then finally goes. And same with this one, goes up and then it has to come back down, back up again. So we don't always get exactly the same price movement. So it's good to also learn sort of the nuances of it as well. So this was prior to the highs at 2000, late 2021, 2022. And the Russell 2000 IWM, the ETF, had been forming at the highs this long sideways range. We've been following this on the weekly market setups along with some other kind of ominous looking patterns. And notice that was forming. This would had been marked in. We were drawing it, and we marked that in to watch it as a potential trading setup. Well, we know what happened. It broke sharply to the downside. And also the next chart, Bitcoin. Here's an example of this is a 3 drive. 1, 2, 3, pretty symmetrically spaced 3 drives to a top pattern. This is a butterfly sell pattern. I had this on weekly setups, and I also had it for stock charts on the daily 5 segment I do for them. So after this drop, no new highs anytime soon. I mean, the market has just collapsed. Here's a Dynamite triangle in there, 4 times the amplitude. And one thing to note about this and these highs, and the same with the highs in our stock indexes in late 2021, early 2022, the sentiment was extremely bullish. Extremely bullish. I saw people all over the place up here saying, buy cryptocurrencies, and I'm staring at these patterns, and you see here's another butterfly pattern right here. So we got a couple of them in succession with this 3 drive, which is a bearish, very bearish setup. And so sentiment, understanding sentiment as well. I mean, people up here were talking about how Elon Musk was buying Bitcoin. I mean, seriously, Elon Musk is not, he'll tell you when he's buying Twitter, but he's not going to be telling you when he's buying Bitcoin unless he's ready to unload a whole bunch to you. So those types of things combined with these types of pattern recognitions can be a huge help. Okay, last chart that I want to show you something else while we close up here. Close this presentation up. I hope you've enjoyed it and learned a lot from it. But here is a chart of Apple, and there were some other charts of Apple and some of the other big tech stocks that were showing really bearish patterns. But this is a big butterfly sell pattern. This is one of the reversal patterns I told you about. So it started to reverse and then it forms the A, B, C, D sell pattern. Now this is a Gartley pattern because this A, B, C, D is contained within this previous swing. We have the butterfly pattern where the A, B, C, D extends beyond that previous swing. But the Gartley pattern is a retest of a recent high or low. So when you have a big reversal pattern like this, then you get that first ABCD Gartley sell pattern. That's something to pay attention to as well. Okay, let me show you something that you might be interested in. So you think, okay, where do I start learning this? We'll start with the pattern recognition. And so this is an introduction course. I have more in-depth courses, but this is like 3.5 hours. You're going to learn a lot. You're going to learn all the structures of the ABCD Gartley patterns, the butterfly reversal patterns, the 3 drive pattern, the Fibonacci extensions. Here's the book that's no longer in print. You'll get a PDF copy of that too. Now, generally on my website, the price is $99 give it to you for $49 with the book. And also I'm going to add you to the weekly market setups subscription for a month free. That's $49 a month as well. So it's about $200 value for $49, and that's going to get you started. You're going to know if you're really want to delve in deeper to this. So let me show you on my website what you need to do. You have to have this coupon code right here. It has to be in capital letters. Follow that. You have to have that. So let me show you quickly. Okay, here's my website, www.tradingliveonline. I should have a thing of me just waving. Hello. So my trading courses are here, but again, your emotions are caution is what I said in the beginning, focus. You've got to have some focus. So what you want to do if you want to take advantage of that, and I hope that you do, go to trading courses. These are some of the other courses. You can look through those, but start here. I'm going to have a bundle of all of the courses into the end of the year. But start with this one here, and this is what you'll see. And so fill out the form. Mine's already in here, but where it says have a coupon, click on this and put that coupon code in, and that will reduce this price, $99 to $49. And so after that, it's a really easy checkout. If you have any problems, please feel free again to contact me, and I will be happy to help you with that. And I will show you again home contact. Here you go. You can contact me here, right here. I also have a trading blog, and put lots of things up on here. And this is the weekly market setups. This is the monthly subscription. If you want to just go straight and take the monthly subscription, then you can do that. Let's see, I can't log in. Should let me in here somewhere. Nope, I guess it's not going to. Okay, anyway, I was going to show you, but we post it as a blog, and it's usually about 20 to 30 minutes, sometimes a little over 30 minutes. Each weekend, I send it out to you, and I'm going to walk you through this stuff and teach you the proper way. I'm a charter market technician. I technical analysis is like in my blood, and I would love to help you guys out. So I hope you take advantage of this special. And again, if you have any questions, just hit the contact here, and I'll help you out. So thanks again for joining me, everybody, and have a great week.